All right, stocks finished the week on a little bit of a down note, though at the end of the day today, we actually kind of rallied towards the highs of the day, though it's still down for most of the major indexes. So we're going to break down what this bearishness for the entire week means, what really drove a lot of that bearishness. We're going to take a look at some significant reversals, it appears, that we're seeing in some major asset classes, the dollar and bonds, bond yields making a dramatic move higher. Well, making a significant move higher over the past few weeks, and that's been impacting, and it's really been a reflection of increasing odds for Fed rate hikes over the next few meetings, as well as decreasing odds for Fed rate cuts at all over the course of this year. So that's having an impact, as well as the data appears to continue to be really, really strong, and this decline in inflation doesn't look like it's going to make it all the way without another hiccup or turn back up to the upside, which means more rate hikes to come. And so the market's not digesting that very well. We're going to break that down. We're going to take a look at some moves in the different sectors, some interesting moves in different sectors, and one of them we're going to use for our trade idea of the day, as the stock has had a bearish pattern develop on its chart today. So we'll take a look at that for our trade and wrap this all up for the week. So let's go ahead and get started. Today is Friday, February the 17th, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, or the red subscribe button down below. Click the thumbs up icon to like our video, comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of these other things over here on the right, including over here. Come down to the bottom, click on this thumbs up icon. It opens up this tab, hit that like button. Same thing here, click that thumbs up icon. Hit that like button as well. Again, the more you do that, it helps get gets our content out to all of our followers on Twitter and Facebook. So it really goes a long way for us. It's free, but it makes a big impact for us. So thank you for those who do like us day in and day out. For those who don't, you can click on this right now while you're watching on this page. And like I said, it will make a big difference for how much our content gets viewed. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see here, we did close better. It was a good close at the end of the day today. We avoided closing below these lows, which you can see obviously we were at the lows of today, and also avoided some extremes on both the momentum line and the near-term line. At one point in time during my technical analysis class today for our premium subscriber, for our Market Scholar subscribers, we had a second consecutive day of extreme levels on the momentum line, and the near-term line was also down at extreme levels. So very bearish from that regard. But the late rally kind of avoided that. And as of right now, if we were to bounce off of this on Monday, that would actually be a pretty decently bullish level. In fact, we had light pink shading here. The intermediate line is below 80. It's falling, but it's still above 80. So that's actually, and again, a pretty bullish sign. Like we're still okay. Intermediate line and market sentiment are both falling. It's not necessarily the best, but we avoided something that could have been a lot worse had we closed near the lows or even lower by the time we closed at the end of the session. Again, we were near the lows when I was teaching my class, and things were not looking pretty good. So good way to wrap up the day. The NASDAQ, you can see, same thing. The intermediate line is rising. We are well above almost 3% above. So, and obviously closing well above those levels. So the NASDAQ looks pretty darn similar to the S&P 500. The Dow Jones Industrial Average actually did close yesterday closed below the 30-day moving average. So we did get the bull tag. We're up today. So we actually had a good update today on the Dow Jones and avoided the near-term line. So this would be very similar, would be another good bullish level for the Dow. So we're actually kind of heading into a new weekend pretty good. Pretty good. The Russell looks even better. The Russell didn't even, remember the S&P and the NASDAQ were below this low point at the lows of the day. Obviously that was not the case for the Russell. So while the Dow has been more bearish, getting below the moving average, and the S&P and the NASDAQ has been kind of more in the middle, the Russell's been by far the better performer. So it's really not going anywhere. Now you've got a couple of Haramis here off this really bullish candle that we had on Wednesday. And the near-term line is falling. So that's the difference here is, whereas the near-term line is already bottomed in some of the other indexes, it doesn't appear to have bottomed yet on the Russell 2000, coming off of what would be a relatively bearish peak because it's a lower high point here than what we had. So that would suggest, that we might not be as bullish as we think. Looking at the weekly version of the market forecast chart, again, very good. Kind of a second straight, transition type candle here. The intermediate line is rising, but the near-term line is crossed down below the intermediate line. So there's an opportunity here to be more bearish if the near-term line were to stay below. Like getting below that, you can see has led to these. Every time we've crossed below, has led to these downward moves, and that we're just now barely starting. And this would be a really bearish peak for the intermediate line. It's not very common on the weekly chart for the intermediate line to get above 60 and not get into bullish this upper reversal zone. If it does peak, it's been pretty bearish in the past. So that's something that, again, considering the near-term line is already dropped and the momentum line's oversold, but not extreme. If we were to follow suit with this with another bearish candle and bring short-term sentiment even more bearish, then that most likely means we are going to get a new leg lower to the downside, and again would be more bearish than even the August peak, because you notice the August peak, we didn't even get above the market sentiment line, and nor into the upper half of the chart. We just barely got out of the bearish territory. This is worse. We are easily in the upper half of the chart. We are in bullish territory, well above market sentiment line. So there's more room to fall. And of course, there's a lot more people kind of getting really, really bullish right now. If you're listening to the talking heads on TV and what you're seeing on Twitter about, the statistics about how we like have a 90% chance of being bullish this year, or 100% chance of being bullish this year based off of the Santa Claus rally and the January effect and the February 14th return. There's a lot of different factors at play that would tell us that we should be really bullish this year, to the tune of like nearly 100% guarantee that we're going to be really, really bullish this year. Up to new highs, up to new highs by the end of the year, 4,800 at least. The famed Tom Lee rally. So if we were to break down here again, because of how we're this kind of failed breakout move, and then again how bullish the sentiment has been. I've showed you this before, but this got updated here. This sentiment chart, the bulls and the bears. We've had 2 straight weeks here. Let me zoom in so we can see it. Looks like that's been updated here to now. It's not quite up to 12.5, but 5.3. You can see the MACD has gotten up to 6, which is really, really high level. Like we've had strong sentiment. We've been getting progressively stronger pretty much since July. The sentiment's been getting progressively stronger, but now appears to be peaking. You can see it peaked there in August, and we fell down. But this would be a much more bullish peak. Again, very similar to what we saw, if I were to zoom out now, to 2008, right? In 2008, right there in the middle, we had a very strong, we got all the way up to above 25. Now, we weren't as low as we were now, but we got all the way up above 25, and you can see the momentum got up above 6 there, got up to 7.5, and we're at 6 right now. So very similar, very surge in positive sentiment, bullish sentiment, and that ended up being the fake out rally of the bear market. Like we started the bear market at that point, and then washed out at the end of 2008. So, that's something to keep an eye on, and why I think that, if this turns out to be a fake out, which means if we get back below 4,000 in the next week or two, and that turns out to be a fake out move, then it's going to be a lot worse. There's a lot of weak hands. There's a lot more weak hands in the market bullish to the bullish side than we are now. In fact, again, another side to see is this scam exposure. And you can see here from the dark pool index just how many people have been bullish during this run, way more than any other time during this bear market. In fact, you have to go out pretty far, like even during some of the bull. Look at during this bull market here, we didn't have nearly this amount of buying going on. We have tons of buying going on here. You can see you had a pretty good amount of buying coming off the COVID low, and that makes sense. We were coming off a significant low point. Over here, you had a significant amount of buying off of the 2015 lows, and then off the 2016 lows, and even over here off the 2011 lows. But again, all of those levels pale in comparison to where we've been in the last couple of weeks. There's been a significant amount of buying, and again, we are not at a low. We're well off of the low. We are not at a low point here. So again, if this ends up being a fake out, you can see a lot of people are going to be burned really, really badly. This has, we really need to root for this not to be one. We really need to root for it to get above 4,200 and to actually be as bullish as a lot of people expect that we will be. Because then we'll be fine, right? We'll be fine. But if we, like I said, break through 4,000, that starts triggering sells from all these buys that we've seen, then it can get ugly pretty quickly. And you can see, like I've said over the last couple of weeks, the bulls have had a hard time pushing through with all that buying. They've had a hard time pushing through as the bears have been around. The bears are in the vicinity here, and they've been unable to be overwhelmed so far. Looking at the weekly chart, you can see again we got the crossover, the bullish crossover. Again, we did not get that in August. So it's another sign of just how much more bullish we are now and how much worse of a fake out this could be. We did get a lower close, so we got a higher close but a lower high. We got a lower high and then a lower close. So next week, if we close below this body, then you can see just how bearish that would be. And again, for us to be that bearish, like right now, the open for next week's candle will be right around 40.86. Right now, we're trading at 40.79. So if we get an average move next week, if you look at like the ATR for the SPX, if you get an average move next week, and right now on the weekly basis, you get about 160 points is the average move, 160 points. Well, you can see like, you know, let's break that down to like 120 points because let's assume maybe we go up 40 points and then break down. So let's say we get 120 point range, a drop next week, which would be about average. If it's a bearish week, it would be an average down week considering the range. Assuming that, you know, we have shadows in between, you know, between the high and the low that would get us to 160. So let's say the body ends up being 120 points. Well, that would end up getting us down to 39.59, which would be below that 4,000 level. And again, not the place that we'd want to be. And we'd actually be back on pace for some of these other declines that we've had here recently. You know, for again, how bearish we might ultimately end up being. The black one, remember, goes back quite a bit. Would go all the way back to that's the I believe it's the 2008. Yeah, it's that 2008 move coming off of that peak in sentiment in mid 2008. So this black line would be a very similar move to that, which would actually, again, if we had a similar move to that coming off of that peak in sentiment 2008 that we have right now, that would get us by the middle of April down to 3,500. You know, and that's relatively conservative compared to some of these other lines that would be even worse. The 3,200's in play by, again, the middle of April, end of April, if we follow the same track as we did coming off of the March fake out peak that we had. All right. So let's take a look at the 3 green arrow charts. Again, no 3 green arrows. In fact, we actually got 3 red arrows yesterday on the Dow Jones. We did end that with a green arrow today, so we closed slightly above that line. We do have a yellow line there. So we have our first sighting of a 3 red arrow move. We still have 2 red arrows on a lot of these others, 1 red arrow over here on the really strong IWM. Looking at the move here today, we were trading below the 17-day moving average for quite a while. We ended up closing below it, and you notice now the MACD is really diverging. So we are in a, like, this is the first time we've closed below the 17-day moving average, especially since the MACD histogram peaked and then the MACD peaked and then crossed. So we're in this convergence pattern until now. Stochastics is breaking down, almost out of bullish territory. It was actually out of bullish territory earlier today. That's a pretty significant move. We are still easily above the 8-week moving average. But again, if we get to 39.59, which is, you know, again, would be kind of an average move if it were a down week, then 39.59 puts us right here, and we're looking at getting below the 17-week moving average at that point. Again, that would not necessarily be the most bullish pattern there. The DMI and ADX are still converging on each other. We're below 30 now on the positive index. We're above 20 on the negative. So because of that, your ADX is now falling. So we're running out of trend strength. Your trend strength is also falling. You can see the trend quality is dropping. The noise balance is dropping. Now they're not dropping to trendless levels yet. So we still have a trend. We kind of have to break that blue line and get that negative rate of change, which we don't necessarily have yet. The oscillator, McClellan oscillator, dropped below 35 again for a second straight day. It was at minus 40 yesterday, minus 45 today. That McClellan summation index is dropping. We do not want it to get below 500. So that's a really important level to watch next week to see if we end up getting below 500. We ended up, earlier today, we were below the 50% mark, which is bearish, right? This first stage of bearishness is dropping below the moving average here. The second stage would be dropping below the 50% mark. This is where we're closing relative to the 20-day range. So we're still in the upper half of the 20-day range, but not by much, right? Actually, that other chart assumes that this is off the table and that, there's the low point. So we were slightly below that low point, that 50% mark earlier today. You can see, though, the problem is, again, with the bullish scenario, is that we are unlikely to get a new high Tuesday or Wednesday. We are well below 50%, and you can see the range is really driving down to low levels. Again, we are setting up for a move, right? We are setting up for a breakout move. We have red dots, which means the Bollinger Bands have moved inside the Keltner channels. We're flirting with the midpoint, so we're no longer in the upper, no longer in the upper quartile, but we're not in the upper half very much anymore. The bandwidth is down to its lowest 150 of the past 150 days. Again, with the red dots, and again with the DMI dropping like it is, and the Ichimoku cloud. Again, we are setting up for a breakout move in one direction or the other, and with everything kind of showing the way it is, you would expect that move would be to the downside. The CCI is already down below minus 100, right? It typically does that on the bearish moves, not on the bullish moves. And if it's on a bullish move, it'll just be very small, but it usually doesn't get below minus 100 on the bullish moves, as we've seen, right, on all these other bullish moves here. So that's a sign that we will start heading down. We're not below 50 yet on the hour side, but we are below 60, so we're not bullish anymore from that perspective. So you see how things are changing. The hull, we got one of the, we were actually at minus 5% earlier today. The size of the candle shrunk, obviously, as we rallied off the lows. But still, it's we are outside the 2.5% mark, and the PPO is below its moving average and falling. So we are starting to trend to the downside here. We saw the weekly chart. You saw these candles, the lower close. Again, you can see that the Hakinyashi differential is below its moving average there too, and rolling over. So you would expect, based on other times it's rolled over, that we're going to start getting some red candles on a weekly chart, which should obviously mean a bearish move. And we're already below the 200 week. We would be getting, if we did get a bearish candle next week, most likely get below the 220 week haul, and you'd start looking for some reversal patterns there. So you see how things aren't necessarily as bullish as we want them to be, and they're more leaning to the downside. We keep getting lower highs and lower lows, and the money flow is dropping down to levels that we just do not want it to drop down to. Remember, we closed at 407.26 over here. We closed at 407.68. And so we should be pretty similar in the volume, and we're not. So that's a concern, right? We should be, we've dropped back down to 407.26, which means we should be coming back down in the money flow to this level, and we didn't even get to that level in the first place, much less get above it so we can come back down to it. So we haven't been as bullish as we think we've been, and this fake out move with that exhaustion gap on the February the 2nd that had that cluster there, I think it's going to ultimately play out to where that's the peak and the start of our move, kind of a longer term move to the downside. Looking at the volatility today, we did finish the day below 20. We typically finish down. We did rally here yesterday and rallied early today, but then finished down, filled in the gap. We are right in the middle of the neutral range, so volatility is not really overbought or oversold right now according to this ratio down here. But we are at 20. And we are starting to work our way up to the upside. You can see when you compare it to some of its average values we're above these moving averages here. We got above the 30-day and the 8 and 17-day yesterday. We're still above the 30-day now. We started above the 50. We've had a couple of failed attempts, but that momentum is moving up instead of down, and so we've got such a large gap to fill to get to the 200-day average value of the VIX. Things are starting to move higher. The VVIX has also been moving higher. It already is above these lines, and the 30-day average about to cross above the 50. That's how much has been bullish. So, and I've told you before, the seasonality for the VIX is pretty bullish right now. You would expect that we'll be bullish here going forward. And again, a bullish move on the VIX with a negative correlation would typically be associated with a downward move on the S&P 500. All right, if we take a look at what's driving this price action, you can see here this week we had a really, really good move going into the last hour of trading on the stocks, the Qs, S&P, IWM especially. Bonds were down, so that means yields hit their highest point of the week this morning before giving some back here by the end of the day today. That's really the biggest reason why stocks rallied into the close, is the dollar came off of its highs of the week and yields came off their highs of the week. And remember, again, higher yields, higher dollar, higher commodities have been the biggest factors for the bearishness that we've seen. Those two, the dollar was at a high, the bonds yields were at their highs, but commodities were at their lows, and that's actually a concern. If you take a look at commodities here, and let's go to the market forecast chart, go to the DBC, you can see that the intermediate line's bearish. It's rolling over in neutral territory back into bearish territory. If you look at the weekly version of this chart, you can see we've been dark pink shading in a red line for quite a while. It hasn't broken below that 38% retracement of this big, long intermediate run that commodities have been on that's pretty much fueled this bearishness and all this inflation. But we have been bearish. And again, the more bearish we are here with market sentiment dropping down, that's not a good sign. Commodities don't correct in bull markets. So if they continue to correct here, then it'll be another sign of kind of this bear market that we're in. That ultimately could lead, or at least coincide with the recession. If you take a look at long-term bonds, they had a nice little rally. The intermediate line got up to the midpoint, a couple near-term moves up to the upside, but the near-term line crossed back down below market sentiment into bearish territory, into the lower reversal zone for both of these, where market sentiment still is. And you can see we're right back to dark pink shading and a red line, just like that. We're not in bearish territory yet on the intermediate line, but again, this would be a pretty bearish peak. I don't think necessarily we'll get to new lows, but I definitely think that we'll trade around this 100, maybe a little bit below 100 here for a while as yields stay up higher to reflect the hawkishness that's in the markets. You can see we ended up closing this week for a second consecutive week, really a third consecutive week. We ended up closing up to, fourth. We were at 3.48, 3.51, 3.53. So 4 straight weeks of higher yields coming off of that mid-January low point at below 3.5%. Now we're above 3.8 and working our way up. Strong short-term sentiment to the upside, the intermediate line turning back up. So you can kind of see what's going on there. The dollar's been something we've been talking about as well. It's also on a 4-week streak to the upside. This really brought the short-term sentiment up to very high levels, extreme levels to the upside. Intermediate line still in the lower reversal zone, so it's got a long ways to go to be really significantly bullish. We still have dark pink shading and a red line, so we're nowhere near reversing things. But so far we've held that 62% retracement, and we're potentially getting back into the upper half of this bullish rally that we've had. That really for this on this chart, this was kind of the daily rally that we had on the daily chart. But if I were to switch it to this chart, the move that we've had here coming off of this low point, you can see the intermediate line, this whole dark green shading green line move. We're basically hit the 50% mark of that rally and bounce, and now potentially getting back above what was support and now would be considered resistance at that point. So getting back above 28.25 on UUP would be significant there. Even though momentum line's dropping, but your near-term line is still very strong, still well above the intermediate line. So we'd have to get back below that for us to be still considered kind of bearish at this point. So you'd expect that we'll probably get some weeks of bullishness here. Also, Bitcoin is something we've been paying attention to. It's got dark green shading and a green line again. It's moving higher. You've got some bad prints on some of the a few of these weeks here, but you can see how we are back up above the 23% retracement. So we closed the week here at 24,500. It's a pretty strong move to the upside, and we'll see if that continues with this dark green shading and a green line. Here's what it looks like on the daily chart. Again, skewed a little bit because of these bad prints here, but you can see after that really down move on November the 9th of last year, we've been kind of trending up, and now we're kind of getting higher highs and potentially a divergent high point. So it's something we want to pay attention to. ARK Investments is a similar, it's got similar pattern to it because it's again on that high end of the risk appetite scale. Here's what ARK Investment looks like on the weekly chart. We are above the 30-week moving average. We got bear tags. Now the question is, will that bear tag turn into a bullish move, or will it turn into a bearish run to the downside? And as of right now, that was almost a bear tag, and it turned into a bearish move. Near-term line's already crossing back down below the intermediate line, just barely. So if we follow through on this, kind of off of this high point into next week, then again, that would be bearish for this, and you would expect it to have a similar pattern on other risk assets that are risk on, including like Bitcoin, for an example. Okay, now let's take a look at how the sectors have performed here. So let me break down the sector moves. And here, let's go to this past week and how they performed this past week. So right there we go. All right, and you can see again, going into that last hour, XLY, XLK, XLC, all doing outstanding, giving some of that back. You can see by the end of the week, your safe haven areas, utilities and staples ended up pretty strong. In fact, they ended up your strongest on the day today. When you just look at today alone, you can see here staples, utilities, healthcare, all your biggest winners. They actually were up pretty good early when things were at their lows of the day. But even as things rallied, they rallied too. And so they ended up the only sectors that were actually up. A few others, discretionary, financials were flat. Communication services was flat. XLK was down 1.25 off its lows at around 2%. Energy just getting hammered. And if you look at how these sectors are doing here, when you look at the 12 grid, you can see how energy is just getting hammered right now over the last little bit. And really over the course of the whole week. But look at that move. I mean, breaking down below those lows, dark pink shading and a red line. Remember, energy stocks have kind of outpaced the price of crude oil, so they're really, really elevated from that perspective. And it appears they may be losing that. And again, if commodities correct and energy stocks go down with them, that tends to, these kind of stocks that do so well in the late stages of bull markets and early stages of bearishness, they tend to not do well during the, kind of the middle of the bearish stages and towards the end. And so this would be a sign that we may be transitioning from the early stages of bearishness to a more sustained, more bullish, a more mature stage of bearishness there. So everything else is looking good. Dark green shading, green line across the board, though we are coming back, that we're converging with the moving average on all of these, just like the S&P. We got light pink shading and yellow line on real estate, on materials, almost on communication services. You have light green shading and yellow line on these other safe haven areas, but they're kind of moving in the opposite direction. They're moving up and converging up towards these moving averages while everything else is moving down. You can see that reflected here in this rotation graph. Bring this up here. You can see the cyclical areas moving down to the left, XOK, XLY, XLC moving up to the right on the longer term chart. On the daily chart, they're moving down. So there's XOK, XLY, XLC, staples, utilities. There's industrials, energy, financials, materials down here. But that you have utilities, healthcare, and staples, all the strongest momentum and moving up to the left. I mean, that's safety. The market is rotating right now into safety. And again, that's not necessarily the most bullish sign. And your three areas of bullishness are rotating down to the left, so out of these cyclical areas. again, not the most bullish. That's a bearish cycle. It's a bearish rotation going into, coming out of this peak of the market that we've seen. In fact, if I were just to look at the last 20 days here, you can see that rotation, right? Down to the left, up to the right. We are clearly rotating out of these strong QQQ type names and into these safety trades. And again, when you look at like QQQ relative to IWM here, you can see the weakness showing up, breaking down below the 17-day moving average there. If I look at the weekly chart, we've been relatively strong, but we may be hitting up against resistance there. Some of these credit spreads that we kind of pay attention to see whether or not whether the bond market's reflecting this risk aversion or not. We're starting to see some weakness there in the high yield end of that credit spread. And then if you look at the investment grade end of it, here you can see we're actually getting a little bit more weakness in that end of it. So things are starting to peak on the MACD and roll over, especially on the daily chart. When you look at the daily chart here, you can definitely see the peak in the momentum. We're dropping in the momentum. They're dropping below these the 50-day moving average in this case, and then the long-term PPO appears to be peaking, and we're dropping to bearish levels. So even the credit spreads are reflecting a change from risk appetite, which we've seen pretty much since that mid-October low point through the beginning of this year, into now potential change into risk aversion there. One of the areas in the market is kind of struggling here in the materials sector. You can see it's a little bit more bearish than most of these others, aside from energy, of course. So I wanted to take a look at a stock in that area that had one of the bigger down days today. In fact, when you look at like this chart here, and I go to, let's go over here to my watch list, and you look at some of these energy stocks really getting hammered the most. A lot of these energy stocks down here, but you can see some of these material stocks getting hammered quite a bit. Newmont, Zillow down there. X is down here as well, somewhere in this area. Alcoa. So I wanted to look at X, right? U.S. Steel. U.S. Steel actually broke below multiple moving averages today. After kind of peaking yesterday, or peaking a couple days ago, and then a little bit of a neutral candle yesterday, then dropping big today with a lot of volume. MACD has been bearish, stochastics has been down, and it has been down in the bearish territory, maybe peaking again there. Looking at the long-term chart for U.S. Steel, again, you can see how we've had multiple transition candles, but this one closing below that body. So you've got the reversal pattern. You can see when you look at the regular candles, we did have a bearish candle that last week, and we had a long upper shadow this week. So things are turning around. You can see the differentials turning bearish. It's looking like we are going to have, at least a little bit of a reversal pattern. I wanted to show the weekly chart on this as well for U.S. Steel. Again, we've been so bullish, right? But then that long upper shadow that I just mentioned to you about, that bearish candle, long upper shadow, you can see that stochastics has already dropped below its moving average. MACD appears very close to dropping below its moving average. So things are starting to turn negative for the stock. You can see the light pink shading and yellow lines. That's the bull tag on the market forecast. And the negative indicator jumping up to 25. That's a big level for that particular indicator. We are well below the green and the blue lines. We're transitioning to a bearish rate of change, from a bullish to a bearish rate of change there. The bullish shouldn't be had is gone. You can also look at the Keltner channels here. We have a very, very low bandwidth, way inside the Keltner channels, and now we're moving towards the lowest quartile. We actually were in the lowest quartile earlier today, but we're moving towards that lowest quartile there. And you can see its whole moving average has been bearish. We try to get bullish again. We flip back down without flipping the parabolic SARs. You can see the MACD has been on convergence mode this whole time, and it appears we may be starting to break below that 200-day hole now. So things are turning over. Lots of bearish signs on this stock, below the moving average, below the midpoint of the chart, getting into low levels. So what I decided to do here was say, okay, let's look at the March expiration. and let's buy, out of the money. Be a little aggressive, buy out of the money, sell that 24, buy the 26. It sets me up for a maximum gain that's right at the 1 standard deviation mark for current volatility levels. But about here, let me actually get rid of there we go, the working order. The $500, which is my normal risk for a directional trade, but over a 4-to-1 reward to risk ratio if we actually end up getting down to, like I said, 24, and which is these old low points from back here. And if you look at, like I said, 1 standard deviation, just 1 standard deviation. Remember that, typically when you start getting some weakness, you start getting down to 2, but there's a 1 standard deviation down into this March level here, and we needed to get down to, where was it? Excuse me, that was SPY. Let's see where it was on X. We need to get down to 24. So when you look at it here, 24 and a quarter is the 1 standard deviation towards the bottom end of this volume node. You can see it's relatively feasible for something like that to happen. It's actually above the 5-year point of control, with a move back down out of the upper quartile of the weekly bandwidth, and working our way down towards with this negative positive momentum, starting to work our way down with a relatively high bandwidth that's falling into the lower half of the bandwidth. And that's really all we need. We don't need to get down to the outside of the lower band. We just need to get down towards the lower half of the bandwidth, and into any part of the lower half of the bandwidth, and we can get a pretty decent reward for the small amount of risk that we're taking. All right, that does it for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between the videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel. Hit that thumbs up icon. Comment on the video. Subscribe to us on MarketScholars.com for free. Follow us and like us on Twitter and Facebook as well. Have a great rest of your weekend, everybody. Happy President's Day, and we'll see you all next week.